Hello, everybody. Okay, let's begin. Well, welcome everybody to another webinar of our series. Today, we're going to go down the path of technical analysis once again. More specifically, we're going to talk about Fibonacci and even more, much more specifically speaking, we're going to talk about Fibonacci retracement. So this is a new topic on our series. Over the past week, we have covered many different technical indicators. If I'm not mistaken, last webinar we've done moving average, convergence, and divergence, the MACD, and more specifically MACD strategies. Over the past, we have done Bollinger Bands. Ichimoku is going to be up next, if I'm not mistaken. We have done RSI, moving averages in general, and moving average strategies. And we have many more to do down the path of this webinar series, if you would like. So I think it's time to begin. Let's just jump right straight into the point. So this is a risk warning and a disclaimer. I'm not going to go ahead and read this out. The gist of it is that this information is not for investment advice or investment recommendation. It's just for educational purposes only, and the redistribution of the material is strictly prohibited. Now, let's get started. So types of technical analysis, we have mechanical analysis and charting analysis. This charting analysis, we have covered that in the past in depth. Now we moved on to the mechanical analysis kind of category, if you like, and we have a split of here of on-chart and off-chart indicators. More specifically, today we're going to talk about Fibonacci retracement. We have covered the ones with asterisks. So we have done moving averages, Bollinger Bands, and RSI and MACD. We're going to do ADX in the next few webinars, momentum as well, Ichimoku clouds, and hopefully parabolic SAR as well. Today we're going to focus on Fibonacci, however. So what is Fibonacci retracement? Specifically, let's get things straight by talking about what Fibonacci is in general, not Fibonacci retracement. So the retracement, Fibonacci retracement as a tool is extracted, if you would like, from the broader concept called Fibonacci as a sequence. So the Fibonacci sequence was, in a sense, identified by an Italian mathematician called Leonardo Bonacci in the 13th century. However, it was widely, and it is widely believed that Bonacci did not create the sequence, but he, in a sense, rediscovered it, if you would like, or the concept was introduced to him by some Indian merchants, which this kind of, they have told him apparently that this kind of sequence, or the origins of the Fibonacci sequence, can be tracked back to the 6th century before Christ, if you like, so BCE, in ancient India. So if you like, ancient people knew about this kind of sequence, or this kind of ratio which is extracted from the sequence. So the Fibonacci sequence is closely connected to what we call the golden ratio, which is the 1.618, also known as the divine proportion, and it can be interestingly found in many aspects of this, what we so-called reality. In sunflowers, you can see this kind of ratio in the way that the petals and the flower in general is formed, in seashells, in galaxy formations, in historical artifacts, in architecture, in faces, in pretty much everywhere around there. You can spot this kind of ratio. So what is this ratio and how can we extract it? So it stems from the Fibonacci sequence, which is a series of numbers that starts with 0 and 1 as the primary components, and all the others are extracted from this. How, you may ask? So you have 0 and 1, and you have each subsequent number is being the sum of the previous two. So for example, you start with 0 and 1 and you add those together, you get 1. So 1 is a new number and the prior one is also 1. So 1 plus 1 is 2. 2 plus 1 is 3. 3 plus 2 is 5. 5 plus 3 is 8. 8 plus 5 is 13. 13 plus 8 is 21. 21 plus 13 is 34, and it goes on indefinitely. Okay, so you keep adding those numbers, you get an indefinite kind of sequence of series of numbers. So when it comes to trading, practitioners or technical analysts, traders in general, are commonly using this kind of ratio and other related ratios, the 1.618 plus many others, to establish at the end of the day support and resistance levels, which are applied on market waves if you are extrapolating, or if you are assuming that markets are following a so-called random walk, but at the end of the day you get some sort of predictive patterns, and those predictive patterns can be split down or decomposed into scales or into portions or into waves, in other words. So this kind of ratio, this kind of tool or technical indicator is primarily used in accordance or with the pairing of what we call Elliott waves, which are hopefully we're going to do a webinar on them. It's that not so easy to digest kind of topic. Mainly the gist of it you can get, but you need a lot of attention and read-through process in order to understand fully what this kind of theory is proposing. Hopefully we're going to do a webinar in the future breaking down these kind of concepts and this kind of theorem, if you will like, and hopefully we can apply to our charts and get this kind of what kind of view or what kind of picture is created by these kind of waves. And the reason why we use Elliott waves as a theory is because it has a fairly decent predictive power on categorizing, let's just say, the moves of the market. We're talking about medium to long term kind of trends, which are super helpful to comprehend and understand, because you can, at the end of the day, if you study them closely enough and pay enough attention, you can get let's just say a competitive advantage, or at least you're going to be a little bit more aware of acting in the financial markets, and hopefully you're going to have the probabilities lined up on your side rather than against you. So the more you know, the better at the end of the day. So just summarizing these past points, so we use Fibonacci retracement in order to establish resistance and support levels. We don't use them for any sort of predictive kind of ability or capability. So is not yet again another tool that we use in order for us to use as a crystal ball that's going to tell us what the price action is going to bring into the future. We use it merely for us to have some sort of levels to be paying close attention to, and hopefully if they are acting as support resistance levels, from there onwards we can find a good enough place or good enough price to start trading, and use those kind of levels as either entry or exit points. In order, in a sense, you use this kind of information and you act upon it depending on what it is conveying. So enough about this. What are the other key ratios that are used by traders besides the 1.618 or the 61.8%? So the other key ratios are, except that the 0.618 is pretty much the most widely known one. So pretty much a 2/3 kind of retracement or extension of the move. In this kind of case, it's going to be a retracement because we talked about Fibonacci retracement. The 61.8% retracement is deemed to be the most significant one, mainly because it plays by the rule of the Fibonacci kind of golden ratio kind of narrative. Other important points are the 38.2% level, the 0.382, and another one is the 23.6% level. Oh, excuse me, the 236. Okay, you're going to see them in action pretty soon. Okay, so even though finally closing that the 50% level is not part of the Fibonacci ratio in trading, it can be used, and it is being used as a solid support and resistance indicator of the prior move that we have observed. Okay, so Fibonacci sequence, as we just mentioned, has two components, 0 and 1, and you add each subsequent number with the one beforehand, and you get a new number on the series, which the series goes indefinitely. So the Fibonacci ratios, we just talked about them. Let's see how they are computed. So they are found, in a sense, by dividing any number in the sequence by the number that immediately follows it. So if you take, for instance, the 21 and you divide that by 13, or more specifically 13, divide that by 21, you get approximately 61.8% or 0.618, which is the primary or the most important kind of ratio in this kind of sequence. So if you take a number and you go two places backwards and you divide that number with the one you have in front of you, so let's just say you do, in this kind of case, the 8, and you divide that by 21, you are going to get the 38.2% or the 0.382. And 3 places backwards, and you divide that, you get the 23.6. In this kind of case, it's going to be, let's just say we have the base being the 21. So you go 1, 2, 3. So 5, divide that by 21, you get approximately 23.6. So as you progress through the sequence, and for example, you do the 1,597, okay, and you divide that by, let's just say, the 377. Let's just do it in really, really, really quickly. Let me see. Let's just do 377, divide that by, where is the division? By 1,597, you're going to get 3, okay, 0.2, 3, and 6, or a 23.6%. You get the 23.6% by multiplying that by 100. So 23.6%, or the third most important one, if you would like. So let's just do another one. So you have 1,597, and you divide that by the 610, excuse me, and you divide that by 1,597, you're going to get the 38.2. Okay, so it's an approximation. So if you round the number up, you're going to get 38.196. So it's going to be 2. Okay, so let's do the final one. So 987, divide that by 1,597. You get the 618. Okay, that's how you get the ratios. Okay, 618. So these are how, this is how these kind of ratios are calculated, and the whole importance comes because there are numbers of these kind of series, of the Fibonacci series, hence the Fibonacci sequence, excuse me, the Fibonacci retracement as a tool. That's how you use it. That's how the ratios are calculated. We're going to talk about how you use them. So the Fibonacci levels are not mechanically, they are automatically drawn, if you will, like, if you connect a peak with a throw and you use the tool, you select the peak and you select the throw, the levels are going to show up with these calculations above it. So the 61.8, the 38.2, the 23.6 are going to be automatically placed on your chart. You're not going to be drawing any lines. You can draw lines on top of it and see whether it's aligning some sort of way with past price action, and whether that kind of level that is shown there is important or not, is to be judged by you, but also in this kind of case with the help of the Fibonacci sequence. So if you see a level of price action that has trended in the past and was used in the past, And we have seen price action gyrating and failing to break above or fall below that, you brand that as a valid resistance level. So once you do your charting analysis first and you have established your support levels with the naked eyes, you can use the Fibonacci retracement tool in order to confirm whether those levels you have selected are good enough or they are valid enough from another point of view, with an additional layer of let's just say sophistication, quote unquote. That's a big quote unquote. Okay. So we use these kind of levels for support and resistance. We use the Fibonacci ratios, the retracement, as a tool to highlight possible areas of support and resistance. Okay. That's why we use the Fibonacci retracement. So Fibonacci levels are drawn by connecting two extreme points on a chart and dividing the vertical distance by the key Fibonacci ratios. These levels can act as key support and resistance levels in the course of a retracement. So retracement is, for example, when you have a market or an instrument trending upwards in this kind of case, and you see higher highs and higher lows. At some point in time, you start to see a peak being formed, and then you extrapolate that possibly we're gonna see the price action falling down from there onwards, because the bears are in control. They have taken over and they are in charge of the direction of that instrument. Now the question that arises is, how far is the price action going to retrace? How far back the price action is going to fall? Maybe if you use the Fibonacci retracement tool, you're gonna have some sort of clear indication of where we could reasonably expect to get some sort of support, because it's not going to fall endlessly. That's not how market works. Markets are moving in waves. In this kind of case, we are we look for an instrument that has moved a lot, and now it's time for the bears to come into the picture and correct the move, because it has gone way far ahead of itself. Now, why we use the Fibonacci retracement tool is to figure out where that retracement, where that correction is hopefully going to end, because we want to capitalize upon that, okay, accordingly. So at the end of the day, retracement is a move in the opposite direction of a prevailing trend, whether that is an upwards market or a downwards market. I gave you an example with an upwards moving kind of market. This is what we call a retracement with a red arrow pointing downwards. Okay, right here. This is a retracement. So you have the top here and the bottom here. We draw the Fibonacci and you get the levels. And we see from there onwards where the price action is headed at. It's okay. So hopefully that is understandable from your point of view. If not, please let me know in the chat whether you have any sort of questions. More than happy to answer them. For the time being, I'm going to assume nothing is being not digested. So I'm just going to continue downwards. So how the Fibonacci ratios translate into trading, what we do care about. So Fibonacci retracements are a method of analysis for determining support and resistance levels. So they are named after their use of the sequence. And the Fibonacci retracement is based on the idea that markets will retrace a predictable portion of a move, after which they will continue to move in the original direction. Okay, so you can think of retracements as a hiccup. Okay, so the price action is moving to a specific direction, let's just say upwards. At some point in time, because the market has overextended itself, we assume, correctly so, that it's going to have some sort of pullback or a retracement, because this cannot keep going forever, because once again, as you can observe from financial markets, they move in trends and in waves. We, at the end of the day, look for these kind of pullbacks, these kind of retracements, in order for us to, let's just say, capture the move with the expectation that the market is going to extend or move to its desirable direction, or the predominant kind of direction, after this full correction has been made. That's why we use that. Okay, so Fibonacci retracement is created by taking two extreme points on a chart and dividing, at the end of the day, the vertical distance by the key Fibonacci ratios. In this kind of case, start of the move is considered to be the 0%, the start of the retracement, and the 100% is the complete reversal to the original part of the move. So 100 may be the peak of the mountain, and the 0% being the bottom of it, or at least the new higher, let's just say, level that we have descended upon. Okay, so once these levels are identified, we have horizontal lines drawn on the chart to identify both possible support and resistance level. So why do traders use this? As one of the most common trading strategies or technical trading strategies, traders could use a Fibonacci retracement level to indicate when and where to enter a trade. And for instance, a trader notices that after significant momentum, a stock has declined 38.2%, a key Fibonacci ratio portion. So as the stock begins to face an upward trend, they decide to enter this trade. Okay, so because the stock has reached a Fibonacci level, it is deemed to be a good time to buy this, with a trader speculating that the stock will then retrace and recover its recent losses. Now, some traders also combine other key data to provided by technical indicators to confirm whether the expected move will be played out by, again, at the end of the day, again, at the end of each and every decision and day you have as a trader, rationalizing probabilistically rather than taking the levels provided for granted. Okay, so you, in a sense, use this information with many other technical tools that you have at your disposal in order to get convergence or confluence, or seeing that there is an alignment, and therefore if you do that, you have much more, a higher percent of probability that your trade is going to be beneficial, if and only if you do your analysis correctly and the market gives you that opportunity. Okay, so this is a visual illustration of the Fibonacci. Excuse me for a sec. Fibonacci retracement indicator. Okay, so you have the peak of the move being the 0%, the start of the move being the 100%. So from here onwards, you get what we call the Fibonacci ratios, or the levels that we're going to go ahead and look upon to see whether they have some sort of significance. So you start from down here and you end here. So imagine that from this dotted line onwards, we did not have this information. We just plotted this at this point in time. And now we are wondering where the price action is going to head towards to next by plotting these kind of ratios on top of your price action. You're going to get some sort of support and resistance level that is going to be beneficial for you to enter or exit a trade. In this kind of case, we see the pullback or the retracement from the below the 23.6% level. Okay, broke below, came once again above it, but afterwards it continued moving onwards. Then as traders, we go to the next ratio, which is the 38.2. We have seen some sort of consolidation or this level acting as support, mainly because it has reached this kind of level in the past. We see again another break below this kind of level, and then we go to 50. Same thing, the same rational extents. So as the price action breaks below the 23.6 and the 38.2 and then the 50, the only resort we have is the 61.8, which is the let's just say most important anyways. And as you see, the price action went down here, bounced once, bounced twice, and then headed back towards the 50 level. So now we start to pay attention, because now we assume that, let me keep my pen. We assume that This is the start. This is the peak of the move. This is the new low. And once again, we're going to get a new high. Okay. So you see how we just zoom out and look at this kind of erratic price action. Okay. And we draw a much more smoother line telling you that this is probably a new higher low. And once you see once, twice, the break above the 50 and the price action surging closer to the 38.2 level, now we have much more confidence that this is a bottom. Okay. From here onwards, we start extrapolating that the price action is going to head towards to the prior peak, which is up here. So from here onwards, you can go long somewhere in here. Okay. So you can buy a contract here after you have seen this double bottom on the 61.8, the break above the 50%, which is not that important compared to the 61.8 anyways. And then we approach the 38.2% level where we extract from there onwards, extrapolate from there onwards that the price action is going to head to higher ground. So you can buy there and have a target up here or even higher than that. Or you're going to wait to see how the whole thing plays out. Once you see the return back towards the 31.8 and the 38.2% level acting as support, this is a very, very nice area to be paying close attention to and pondering whether we're going to go long on this or not. In this kind of case, I was very, very much decent. Okay. So the same example from the alternative point of view. So we have a downwards trending market. Again, 100% and the 0% of the move. So assume that from here onwards, we don't have any clue what's going to happen. And we use a Fibonacci retracement tool in order for us to find these kind of areas. Excuse me, of areas of importance. In this kind of case, the retracement did not last long enough. We didn't go up here to the 61.8% level. However, we have seen the 38.2 acting as resistance once, twice, 3 times, 4 times. From here onwards, we have a clear, lovely sign that possibly we're going to see the price action falling back and below. In this kind of case, it was the prior lowest level. This was the new low. This is a new lower low. Okay, and this is a peak. This is another peak. So if you just zoom it out, it looks like this. Okay, so this is an area of consolidation if you zoom out long enough. This. Okay, and the 38.2% level is acting as resistance, and down here you can say 0% or the former bottom acted as support in the past. From here onwards, we are extrapolating that market is going to move towards its original direction, which is in this kind of case downwards. And when would have been a good time to enter the market via a short, so a sell could have been here. Okay, so you enter a short contract here and you have a target exit down here. Okay, so this is sell. You go ahead and buy or close a position there, and from here onwards we just observe the price action. It has moved here again close to 38.2, but it did not manage to breach it. That means that the bears are, in this kind of case, we're eager to push the price action to lower ground. So maybe somewhere in here you go short. Okay, and capitalize upon this breakdown, not break out. Okay, any questions, guys? No. Okay, move on. what to expect in the next session. We're going to do Fibonacci extensions. So pretty much we're going to combine the Fibonacci retracement, which is this tool, with the Fibonacci extension tool, which is going to give you levels in the future if this kind of complete breakdown occurs, which has occurred. What levels are then being shown by the Fibonacci extensions tool in order for us to have at least a target? If you went short here, where is going to be your target for exit? Fibonacci extensions tool can indeed give you such a case, such information as you're going to use accordingly. Okay, so hopefully this has been super simple for you to understand. We're going to go on a live environment and do that in the next webinar. We're going to combine Fibonacci retracement with extensions. Hopefully have a live trading session to see how they are applied on my chart, and hopefully you can go ahead and do the same on yours in order to have a much more informed kind of decision-making process. So this brings us to the end of today's session, guys. Thanks for watching, and hopefully we're going to catch you on to next week's webinar. Guys, if you have any sort of question whatsoever, please let me know. You have the email address you can send me your queries to. Please use that. If not, we're going to keep it here. Thanks for watching, and hopefully once again see you next week. Take care. Bye-bye.